All right, this is Mike Doyle of the mortgage firm Wellington Lake Worth, and we are live again as we are every Wednesday. Just general mortgage questions we want to answer. It's just an open forum, and we will cover certain topics. And today's topic that we will focus on is going to be buy downs. But as always, I'm here with Tom Bennick, and Tom is with Elizabeth. Elizabeth, where are you?
Here we go.
They had a function aid. There she is. And we're getting a lot of requests lately, or I'm getting a lot of questions about buy downs. And I haven't always been the most positive person about buy downs. So actually, I've been very negative about them. And today I'm going to try and show a little bit of the good, the bad, and the ugly, and where their applications could be good, but what you really need to worry about or look out for. So we'll run through that really quick and go ahead and just ask us any questions you have about mortgages.
Obviously popular when rates come up. Can you hear me okay?
Yep,
No?
I can hear you.
Yeah. Sure, when rates come up a little bit, buy downs get kind of popular. But there's goods and there's bads. There's benefits to doing a buy down, and then there's some other ways that you can apply that money and might get better use out of it.
Yeah. All right. So let's just go over the basics. And it's just a financing strategy where the buyer has a reduced payment based on a specific period of time. So the reduced payment equates to the payment that they would have if the interest rate was lowered by either 1 point, 2 points, or 3 points. And basically that what that means is if you have a 2-1 buy down, and let's say for an example, you have a 7% interest rate. So 2-1 buy down means that you're going to have a lower interest rate for 2 years. So the first year, instead of having the 7% interest rate, you're going to make a payment as though you had a 5% interest rate. So it's the 7% that you have minus 2 is the 5%. So you will make the payment as though you have a 5% interest rate. The second year, you will make the payment as though you have a 6% interest rate. So it's 2 points less the first year, 1 point less the second year. And then the third year, you go back to the 7% interest rate. Now, if you have a 3-1 buy down, it's going to be your first year will be 7%, which is your existing interest rate, minus 3 points, which will be 4%. So you will make the equivalent payment. You won't have an interest rate of 4%, but you will have the payment as though you have a 4% interest rate for the first year. Your second year, you will make the payment as though you have a 5% interest rate. The third year, you will make the payment as though you have a 6% interest rate. And then from then on, you'll have a 7%, your regular 7% payment. All right. So it sounds good. Now, the parts that I've become more comfortable with is that if you're a listing agent, your job's to sell the property. All right. So you're out there trying to sell the property. Things are difficult. There's payment shock by the buyers. So it's a tool where the seller can go ahead and pay for, that savings up front and get the buyers to be more comfortable with the lower payment. And they sell it with the idea that you will be able to refinance this house as the interest rates go down. So it's a tool that the listing agents can use. All right. Now, a big thing on this is all those payment savings you save over the 2 years or the 3 years. So let's say you save $10,000 over that period of time. You have to give the bank the $10,000 at closing. So all of your savings over the period of time must be given upfront by you to the bank at closing. All right. What they're sold as is the seller will pay that for you. So let's say it is $10,000, just pulling a number out. The seller pays the $10,000. All right. Now, the seller never really pays the $10,000 because you're basically just paying $10,000 more for the house than the seller really would have taken. So you pay the $10,000 more, the seller gives the money to the bank, and then you have a reduced payment for that period of time. All right. Some of the good stuff, though, on it is that the seller is willing to pay for a buy down. So right off the bat when they advertise that seller is willing to come off their price. So if you contact us, we'll plug that number in and we'll say, hey, they'll pay for a 3-1 buy down. What that means is that seller's willing to come down $5,000, $10,000, $15,000, whatever that number is. So right off the bat, if that seller's asking $400,000, we plug those numbers in there. We can figure out we know right now he'll take $390 or whatever it is. So you have an advantage as far as knowing what the seller's willing to come off their price right off the bat. Secondly, sometimes getting seller concessions out of a seller might be easier than getting them to come off a price. All right. So they've already told all their friends, I'll get 500 for my house. And their friends are like, you'll never get 500 for the house. So they would rather give you 10,000 or whatever money in seller concessions at times, so they can still tell their friends they got 500 for the house. So sometimes you get seller concessions out of somebody easier than you can get them off of the price. So there is a little bit of a psychological element to this. Now, and Tom and Elizabeth, did you have any? I know you guys might not be as negative as me. Do you have any other good aspects to it? You got to get it. Okay.
And here we're kind of on a mobile device here, so the sound isn't that great. So again, there's benefits to it. It does offer a little bit lower payments on the front end, but again, there's just possibly other ways to apply some of that money.
Yeah. So then we'll cover the bad. Again, the total savings. This is the part that hits me on this one. Everything you save over that whole period of time has to be paid to the bank up front. And just think of it. If you have $10,000 less in payments, the bank isn't saying, or the investor isn't saying, all right, look, we're just happy taking $10,000 less over 2 or 3 years. So they're not saying this. Now, in the old days, we had the option ARMs, negative amortization, where you would borrow $300,000 and you would owe $310,000 over a certain period of time. At least we're not doing that. So they're basically saying you're going to make whatever the number is, $10,000 less than what you should be paying over 2 years or 3 years, but you're going to have to give that $10,000 to the bank at closing. So if you talk to any financial planner, they're probably going to tell you, don't pay your money up front for savings that you're going to acquire over a future period of time. All right. And also the bad is temporary relief. So when you buy a house now, there's chances are, especially in the state of Florida, insurance may go up. Taxes will most likely go up as they reset your homestead exemption. So you're probably going to get an increase in insurance, you get an increase in taxes, but now you get an increase in mortgage. So customers get payment shocks with the increases in the taxes and the insurance. That increase in the mortgage can be a lot, and it might put some customers into some financial difficulties. And again, we try and make a serious point of letting the customers know, that their payments, what their payments will most likely go to once the taxes are reset. But it starts becoming a lot for the customers to understand, and it really isn't always explained to them, what's really happening. And I know it's often said, oh, don't worry, you'll refinance because the rates are going down. You'll refinance before you actually get to that payment. But there is no crystal ball. And although there is a projection that we think the rates will go down over the next couple of years, there's not a crystal ball, and you don't want them planning for it. Okay. And we do qualify them at the higher rate. So we're not qualifying them at the lower rate. We're qualifying them at the higher rate, but in their minds, they may have already accounted for that additional money in those first 2 years. All right. Now, the ugly, it goes back to that. If their financial situation doesn't improve over time, they're just going to get poorer and poorer. But also, we're looking at customers refinancing over the next couple of years. So if you've gotten the seller concessions, and I'm a proponent of seller concessions, especially for people that are buying that don't have much money. I mean, if you've got a ton of money in the bank, there's no reason getting seller concessions. Once the seller's going to come off their price $10,000, you should pretty much be able to get the price on the house lowered $10,000, because the seller, it's better off for them. They make more money by just giving you a lower price than giving you the money. But let's say, they don't take the seller concessions. All right. But when you go to refinance, remember, we're going to be looking at how much equity you have in your house, and that's going to come into play. When it comes time to refinance, you may have to come out of pocket with some money to go ahead and get the right amount of equity to qualify for the refinance. All right. So, and we'll go over some examples of what they are. But my conclusion on this is, if the seller's willing to pay seller concessions, okay, and the house appraises for the value, and the house has to appraise for the value, you take the money. You take the money from the seller. You put it in your own interest-bearing account. And if you want to use that money to subsidize your payments, subsidize your payments. If you want to use that money to invest in something else, do it. If you want to use that money to pay off a high-interest credit card, do it. You take the money. You decide what's the best use of your money. I'm not a proponent of taking that money giving it to the investor or the lender, and you paying them back and paying interest on it over the next 30 years. So take the money yourself, put it in your own account. If you want to subsidize your payments, subsidize your own payments. But again, don't give that money to the bank and let them hold it for 30 years while you pay interest on your money. And I would say a big thing is, if you're a lender and you're pushing this to your buyers, you don't understand this business, okay? If you're a buyer's agent and you're pushing this to your buyers, you don't understand this business. If you're a listing agent, you're probably a good salesperson, and I'm not going to fault you for that, okay? But all right. Now, we're going to do just kind of the thought of it, okay? Just understanding a buy down. So we use interest rate because when you say 7%, you can say, all right, you'll make the payment as though it was as though it were a 5% interest rate. But you could do anything. You could arbitrarily say, all right, we're just going to make it $1,000 less a month the first year and $500 less a month the second year. So basically what you're doing is you have the actual rate on this one here. We just said the payment here is going to be $2,400. We're not even worrying about interest rates or anything. In my example, 6%. But we're just saying the payment's $2,400. And every year, in your first year, you're going to save $1,000 a year. I'm sorry, $1,000 a payment. So at the end of the first year, you saved $12,000. You saved $12,000 in your first year. Now your second year, you're going to save $500 a payment. So you've saved $6,000 over that year. All right. So over those 2 years, you've saved $18,000. So that $18,000 is your savings over 2 years. You have to give that savings to the bank at closing. And then you will acquire that savings over the next 2 years in lower payments. So again, I don't know why you would do that. I don't know why you would take that money and not put it in your account. So down here, we have a couple examples that we'll use if you call us and you say, hey, they're offering a 3-1 buy down. What does that mean? So if they offer a 3-1 buy down, it'll tell you exactly what it means. Let's see here. So you can put in whatever. So you say to me, hey, Mike, I'm getting ready to offer a $500,000 a house. I'm going to put 20% down. And basically, I wouldn't even be looking so much at the 20% down. I would know that they just said a 3-1 buy down. So you could be doing 5% down. All right. And let's say you've got bad credit. So you're at a 7.5% interest rate. All right. So what that means, if it's a 3-1 buy down, that seller has basically said, I'm going to give you $22,000 towards your closing. I'm going to give you $22,000 for your closing. I'm sorry, that seller has said, I'm going to give you $22,000 towards your closing. Now, he can only give you $15,000 because it's a seller, because that's the maximum you can give on a conventional loan. But I'll guarantee that seller has no idea that he may have committed to giving up $22,000 off that house. All right. But if you're a buyer, you're a buyer's agent, it gives you a little bit of an insight and a little bit of an angle of what you may be able to negotiate for something like this. All right. So that's why I say, if somebody's offering a 2-1 or a 3-1 buy down, go ahead and call us. We'll go ahead and plug this number in, or I'll share this stuff with you and you can plug this number in. So let's say right here, we get a purchase price of, let's just say we got like a $750 purchase price. And then right here, we're saying 5% down. And the seller, if they understand a little, they might say for 20% down. All right, it's for 20% down. So let's say we got 20% down, and let's say we got a 7% interest rate. Okay. Now this one here on a 2-1 buy down is the seller here would have to be giving up about $14,000. At $14,000, that's what the seller concession is. So the seller right off the bat is willing to come off of the house by $14,000 off of the purchase price. So I would think my negotiation starts at $14,000 minus $750. Now, right here, you can see it's 1.8% of the purchase price, which you can do. You can do up to 3% in seller concessions. All right. Up here, you can see that this amount is 4.4%, which is higher than you can do. You can only do 3% in seller concessions. But it is something to look at. Like, let's say up here you were doing 20% down. Okay, at 20% down, you're still going to be a little bit higher than the maximum on a 3-1 buy down. So let's say you got a better interest rate, 7%, you're still a little bit higher. So 3-1 buy downs are hard to do. They're hard to do unless you're doing them on an FHA loan. All right. So on a conventional loan where you can't do more than 3% SAR concessions, you're maxed out at a 3%. You're probably going to be maxed out mostly on a 2-1 buy down. But I tell you, it gives you an insight of what you're allowed to do. Now I know it's a lot of numbers to throw at you really fast, really quickly. But I think if you take anything away from this is if somebody's willing to give you money, take the money. All right, take the money. But you take the money. Don't hand it over to your friend or a complete stranger or a financial institution and say, look, I'm going to trust you with this money and I'm going to pay you interest on this money for the next 30 years. All right. If somebody's going to give you the money, you take the money and you hold it and you can invest it and you use it how you want to use it. Don't turn the money over. All right.
All right. Now, you can hear me okay. That's why we think that sometimes the 2-1 or 3-1 buy down may not be the best option for the borrower. So there are other ways to put that money towards maybe lowering your rate for the whole term of the loan. This way you're not, bumping up or you're not getting an interest rate increase for the next 2 or 3 years. So again, if somebody wants the 2-1 buy down, 3-1 buy down, we're certainly working out with you. However, we also want to show you the other options of the other things you can do with that, 1.5 or 2% that the borrower is providing.
Yeah. All right. Do we have any other fun subjects to cover?
Heroes money. Quickly.
I can't hear you, Tom.
Heroes money that came and went pretty quick.
4 minutes. It was gone in 4 minutes.
So if that's something that, again, we try to let our borrowers know that you get your contracts ready and get them to us. And I think, Mike, your office you wrapped up a pretty good chunk of that money that went pretty quick.
We got 2 of them. The one we missed? The one we missed had a co-borrower on it. So the co-borrower, you had about another 45 seconds of typing to put their information into. And by the time we had our fastest typer doing that one. So it was probably about 30 seconds later, and it turned out that the money was gone by just being 30 seconds later. So we got 2 out of 3. But had they announced whether they're going to give up more money again? I mean, this was only $700,000. So I think it was 1.4 million, 700. So it might be down to 350. Now, it's not that it's going to go faster than 4 minutes because it takes probably about 4 minutes. It probably takes about 3 minutes to enter your information. So to enter the customer's information, it's about 3 minutes. So it's going to be crazy because you're going to have hundreds of people, and it's going to be a matter of who hit enter a second earlier than the other person, whether the next money gets in. And it is going to be too bad because if you got co-borrowers, I just don't see anybody getting this money that has a co-borrower.
Yeah, there is still $10,000 of bond money that's available. If the Heroes program is not available to you and you're still looking for funds to help you with your down payment or closing fees, we still have $10,000 bond money available for first-time buyers.
Yeah, that bond money is good money too. We need to make sure we're looking at that bond money more. And actually, let's see if we can get some of that up.
And again, with the bond loans, typically the interest rates are a little bit lower than regular rates, and the costs on the loans, meaning the title charges and things, are all set in advance by eHousing. They're the ones that kind of set all these programs together. So they put all the rules and regulations and cost parameters on all these loan products.
All right. So here we have here's the bond right here.
And when we do a bond loan or when we're reserving funds, it's completely different than when we lock a regular conventional or a regular loan or a non-bond loan. When we lock a non-bond loan, we log into the system, we get the rate, we lock that loan. When we're locking a loan, we're actually reserving funds for your loan. So as Mike was saying, we just can't click and reserve the funds. There's a lot of information that's got to be input correctly and in a timely manner for us to click and actually reserve those funds. So that's why we need a contract and everything right in front of us when those funds become available, because they go that quick.
I tell you, I mean, there are for first time home buyers. There's a lot of good things going on. So the hometown heroes, yeah. If we have an opportunity, we definitely want to get it. I mean, it was a holiday. We had our whole team was there. We were all in a conference, and the second that 10 o'clock button hit, we hit enter, and then we had everybody typing as fast as they could, getting as much as we could. And again, we got 2 out of 3. So we're going to do our best to get it for you. But like Tom said, we've got bond money. There's special things for first time home buyers where it doesn't matter if your credit score is like a 660 and you're buying a condo, you're still pricing out the same as somebody who's putting 35% down with 800 credit scores. You're just not taking any negative pricing hits, for some of that stuff. So it's definitely a lot of different programs. We have certain no MI programs. We got the 1% down programs. We got, we just have certain types of programs that can help first time home buyers. So I don't want everybody to be caught up that, it's hometown heroes or nothing.
Elizabeth just gave a great presentation at the office on VA loans. So VA loans are also 100% down. If you're a veteran, and send us your certificate of eligibility or your DD 214, and we can certainly see what you can qualify on a VA loan as well.
Yeah, no mortgage insurance on those VA loans too, which makes it awfully nice. So that's definitely a good one. Here we've got some the bond programs. But I tell you that the VA, USDA, and FHA, that's 6.75, and that's no discount points, reduced closing costs, and $10,000 of no interest, no payments. So that's a good program. I mean, people are out there always quoting something better, but you're generally paying points. So to run a 6.75, especially in this environment with no discount points and reduced closing costs, that's a pretty solid loan. Now the Fannie Mae 7.5, obviously we'd like to always see the rates being a little bit better. It's just that their hometown heroes, let's see, they're going to have that as NA because it was out. But hometown heroes, it came out at 7.125, and then if you were Fannie, it came out at 7.375. So I would like to see the bond line up a little bit better. And then as you can come in, people always start talking about, what about where I have the refundable, the money goes away. There's always something. There's never just free anything. But you can start seeing, as you start getting to these other programs, the rates start getting a little bit more expensive. So, if you got a $300,000 loan, and you're paying 1% more on it, you're paying another $3,000 or so more of interest. So it's easy to give up a couple bucks to you because you're going to make that money back in a short period of time, in the additional interest you're paying. So that's where we got to look and say, are we helping you with it or are we hurting you with it? And if we're helping you, we do these types of loans, but if we're helping you, then we'll do what we can. But, we just don't want to we don't want to get you into something that you just can't afford. That's not going to put you in a better spot.
I want to touch on something else that Elizabeth just brought up. Interest rates, everybody is kind of waiting for rates to kind of come down. But look, we're into the first quarter, or we're getting into the first quarter of this year. And I certainly, from my opinion, we don't anticipate rates really coming down anytime quickly, or maybe the second quarter, maybe the second half of the year. But as far as any kind of, as Mike is pulling up the 10-year right on cue, it's look, 4.3, and the last tick was an uptick. So,
this is today. Not to get not to get a negative on it, but this is today.
Yeah.
So when people keep saying, we get people say, "Oh, I heard rates go down." They're smarter than us because they don't follow them as close as us. Because following these just does not. There's a lot. So we don't know. We just don't know. But the anticipation was that the rates should come down over the next 2 years. We were hoping they'd be coming down the first quarter, and we did have. We had a couple pretty good, like here, we were starting to think that we were coming down into a good spot. But you can see right here, the interest rates are 0.5 point higher. They're going to be roughly 0.5 point higher just since, early February. So it's just crazy how this stuff works. It doesn't matter. You're going to refinance in the next couple of years. So I tell people, if you're in love with that $500,000 house, because you'll fight over that dollar amount. But if that's the $500,000 house you want to raise your family in, you want to retire and spend the time with your grandkids, that's the $500,000 house that you want to spend your life in. Is it not that house at 510? because you're paying a little bit higher interest rate. Maybe you got some stuff for some cost for refinancing. If the house was 510, does that mean that that's not the house where you want to raise your kids? That's not going to be your kids, their house that they grew up in. Take a look at, try not to always be thinking, because the interest rate sometimes just annoy us more than the price of the house. But if it's 500 or 510, a lot of times we're like, it's not a big deal. But if it's 7% or 6.5, somebody might be thinking, I'm just going to wait. And I would say, go on, Tom.
I would just say yes, waiting would be a good idea. However, there's not much product out there. So the thing is finding the property. We all have pre-approvals on our desk for people that are pre-approved and out looking and just cannot find the property, the right place, the right numbers. When you find that property and the numbers match, that's the bigger picture. Get the property, the rate will come up and down through the years that you're in there. The object is get yourself in the front door.
Yeah. Yeah. And again, I've said is there's a certain thing with time, and I have younger kids, and they said the same thing is, I can only sit around so long, Dad, and put my life on hold. You only put your life on hold for so long, hoping that something's going to happen with the feds or the rates or whatever. And sometimes you just got to move on. And I had that conversation with older people a lot where I'm like, especially if they have money, maybe not worry about that extra $10,000 that's in your $1 million plus portfolio, but, get into the house around your family, watch your grandkids grow, or, with younger families, if that's the neighborhood you want, your kids to go to school, that's where you want to grow up, the time becomes valuable. And again, it all depends a lot your financial situation, because if you don't have the finances, that's not a choice for you, so you're hoping something's going to happen. But if you have the ability to afford the house, and you're looking for 10,000 here or 10,000 there, you can be losing a lot of time trying to chase that perfect scenario.
A lot of time, and a lot of other maybe missed opportunities where it would have worked out, but this wasn't exactly right. That wasn't exactly right. The rate wasn't exactly right. So there's going to certainly have to be some give and take when you're out shopping.
Yeah. Again, I'm a big proponent on long-term buying. If you just graduated from college and you're thinking, I think I'm going to move out to Oregon, but I might buy a house now for a year. If your intent is not to be renting that house out when you move, but to sell it, I wouldn't be buying something with the intent of selling it quickly. But yeah, if you're buying long-term, absolutely. Or if you're buying and the numbers make sense to where if you transfer jobs and you can end up renting it out, then that's another way too that would make sense.
And I'll tell you what, rentals aren't getting any easier from what we're hearing from the realtors. As far as getting into a rental, you're up into the first, the last, the security deposit. If you've got a dog, well, you got to deposit the dog as well. And now they're checking credit scores. You got to have like over 700, 720, 740 credit scores to rent. And that goes on every year. Every year you get to go back in and go get your the approval from your landlord. Can I rent again for another year? So who wants to go through that nonsense every year? No.
Yeah, I need to get this off. This is I did not see that. Jeez.
Bring it down.
Just a tad, so.
Yeah, look at Elizabeth. That's better.
There you go. You opened up a whole can of worms with those interest rates. I know that they've been up and down, but one of the things that I also want to mention is the minute that we start seeing interest rates start to drop, it's going to be so much harder to find that house that you actually like, that whatever the price of the home is, trying to bid. If you guys remember what happened almost 2 years ago, I mean, it wasn't that long ago. You had you're going to go from having maybe 5 to 7, currently right now, 5 to 7 offers on the table for one particular property to 15, 20 people on the same property. So I get the interest rate part, but at the minute that interest rates start dropping a little bit, the fight to try to get into the property of choice is going to be a lot harder. So just something to keep in the back of your mind and think about. And thank you, Tom, for letting me squeeze in here. Well, like half the time, like my face was like this half the whole entire time. But but no, it's definitely going to be a bidding war once again once these interest rates start coming down.
All right. What else do we have coming up? Do you have any PR bakery classes coming up, Elizabeth?
Oh, I'm sure. We're still doing the classes. We're going to shoot again for the first week of of March. I believe we're trying to shoot for the 6th, but we'll go ahead and confirm. And I know we have a few classes that we want to do at our Wellington Lake Worth office. So just whatever information we're always here to provide for you guys, and just continue to share our Facebook lives, and that's it. We're just here to help everybody.
All right. All right. Well, guys, let us know if there's any topics that you'd like to cover or anything we'd like to cover. And we will see you next week. So have a great week.